people to join. Yeah, I think someone mentioned accountants and jokes. That's a good point. I think we should run the actuarial jokes in this. Okay, we'll give it a moment. Usually people would just be joining now. Start just hit 12. All right, what I might do is kick off with my introduction, then hand back to you, Owen. Okay, so
Yep.
welcome everybody to today's webinar, FSAA, in conjunction with Owen Tong. Today's session, as you know from the invite, IFRS 17. What we're doing with this webinar series is just doing a bit of a deeper dive into some of the subtopics within IFRS 17. It's been a lot of training offered in the marketplace for IFRS 17. But what Owen's kindly doing for us today is doing a little bit deeper on specific subtopics. We had one earlier in the year, and during that webinar, Owen went into some of the requirements to sort out insurance contracts into different groups. And in this session, I think he intends to take this a little bit further and understand the different elements required to quantify contracts within a given group. So if for those who didn't attend last time, I'll just do a bit of a brief intro to Owen. So Owen Tong is the founder and managing director of Real Value Consulting. He specializes in the interpretation and application of IFRS 17 and has gained a wealth of IFRS 17 specific knowledge over that time he spent specializing in this space. He's built a number of models, PAA eligibility models, and assists a number of companies in this space. So with the likes of QBE, Westpac, Deloitte, AMP, Hanover on their journey. He's also teaching at Macquarie University in the fields of actuarial studies, finance and statistics over the last 14 years, and is also the founder of a tuition center called Real Value Tuition. This session will be recorded, so this topic sometimes is quite technical and you may want to revisit it, so please feel free to refer back to that. We'll put it back up on our website. The presentation, I understand, will be around 40 minutes with some Q&A time at the end, so please drop your questions if you have anything in the chat, and we'll get to as many as we can at the end. But I guess on behalf of the FSAA, thank you, Owen, and welcome, and I'll hand over to you. Thank you very much.
Thanks, Steve. And I'll just share my screen and we'll get underway. All right, so the screen share should now be in action. So if there's any issues, just please let us know. So welcome to the webinar, guys, the second webinar in the series. For those of you guys who have missed the first webinar, as Steve has just said, I went through the levels of aggregation. So I went through, I guess, an intuitive understanding of how we need to sort our contracts into, I guess, the three hierarchies, the profitability groups, we have the portfolios, and then finally we have the issuance groups. This webinar kind of extends some of those concepts from the first webinar, but we're going to dive a little bit more in depth into the core measurement components. And so this webinar, the objective of this is to give you guys, again, similar to last time, an intuitive understanding of some of these concepts. As you guys would appreciate, there is a lot of terminology within IFRS 17. There's a lot of complexities, but understanding these terms intuitively and from a conceptual point of view, I hope would help you guys with your measurements and with your work, your daily work in your organizations. So let's start by laying out, I guess, the agenda. There are four core elements that I want to talk about, and then number 5 will be what's next. And so the main part of this webinar will be focused on the first 4 elements. Now, IFRS 17, as you guys would appreciate, those of you guys who have done work within this space, there's a lot of concepts that weave in and out of each other. So there's a lot of paragraph references that references to paragraphs below a certain point or above a certain point, or references to, I guess, different appendices. And so when I'm taking you guys through this, I always find one method that generally helps to alleviate some of the complexity. And this is a layered approach that I like to take. So for example, I'm going to be talking through 4 elements with regards to these core measurement components. The first one will be measurement phases, liability. The second one will be the types of liabilities. The third one will be the measurement methods. And the fourth one will be the components within the liabilities. When I talk through each one of these 4 elements, there will be references in paragraph wordings to some of the elements below. Now, as far as possible, I want you guys just to focus on the understanding of each element as I go, and then I'll try and tie all together towards the end. So one thing I just want to also lay out is that these concepts, they're explained from the perspective of a general insurance company, a direct general insurance company, and there will be some areas that won't be covered in detail. So the mechanics of the measurement method. So if you guys are here trying to understand mathematically what numbers will go up or down in what quantum for the different measurement methodologies, or how exactly to measure onerous contracts, this I plan to cover in a future webinar, because these content alone, they can actually take up an entire webinar by themselves. So they won't be covered in great detail here, but I will touch across some of these concepts here. So just a disclaimer before I start, the information provided in this webinar, it is intended for entertainment purposes. And it doesn't take into account individual or company objectives. Before acting on any of this information, please consider the appropriateness of this information provided and the nature of the interpretation, having regard to your individual company's specific situation. Alternatively, you may reach out to a real value consultant that specializes in IFRS 17 to specifically assist you and your IFRS 17 needs. So without further ado, let's begin the main part of today's webinar. So the first thing I'm going to talk about will be the measurement phases. Now, IFRS 17, when they lay out their standard, if you think about the objective of this standard, it's supposed to be a fair representation of what the company is actually doing. So we're writing insurance contracts. These are our insurance products. We want to try and measure these insurance products so that our balance sheets can be more comparable to the balance sheets of non-insurance companies as well. So IFRS 17 has 2 measurement phases that they bring out, or I'm calling these 2 measurement phases. And I find it always worthwhile to distinguish between the 2. The first phase, which is referenced in paragraph number 32, is the initial recognition phase. And the second phase would be the subsequent measurement phase. Now, as you guys can see, there are already references to fulfillment cash flows and time value of money and risk adjustments and contractual service margins. These are what I was saying before, part of the elements that I will talk about later on. So for this section, I just want you guys to focus on the measurement phases and the objective of these measurement phases, which are the initial recognition, that's the first phase, and the subsequent measurement. So when an insurer provides insurance services, we need to recognize that and quantify that and report that in the financial accounts. Obviously, when we first issue insurance contracts, we need to initially quantify that. So what is the product that we're selling? This is why there's a section called initial recognition. But when an insurance company has just sold the product and you've quantified it at the very start, that product or the quantification largely depends on a set of assumptions. Those sets of assumptions, usually they change unless we can read the future. And so subsequent measurement is the process of subsequently quantifying the, I guess, our insurance contracts and our promises to the customers and reporting on the most up-to-date numbers for those contracts that we originally initially quantified. And so these two phases are kind of like they come in tandem because we can compare our subsequent measurement numbers to our initial recognition amount as well. And there are disclosure requirements in the standards that are different between initial recognition and also for subsequent measurement. So if I just kind of like put them side by side, initial recognition, as I have talked about, we have to look at the contract at the very beginning when we're issuing these contracts. And if you came to the last webinar where I talked about the portfolios and profitability groups and issuance groups where you sort your contracts in, that's where you actually do that, initial recognition. So at the very beginning, you need to place or sort your contracts into those profitability groups or the issuance groups. You need to also assign a measurement methodology. So how are you going to go about measuring these? And I will go through the two types of measurement methodologies that largely applies to general insurance companies later on. And then finally, once you know which groupings to put these contracts in, and once you know the measurement methodology, go and measure it and establish the initial balance sheet components. That's initial recognition. You kind of like work that out, lay that out. Then we move on to subsequent measurement. So in subsequent measurement, we can't change the groupings that we've already recognized. So for new contracts, we can, but for contracts that have already been placed into specific profitability groups or issuance groups or portfolios, we can't then change the groupings that they belong to. But what we can do is update our assumptions. So we can adjust the balance sheet components, and that may change the profitability. So we might think that claims will go up or go down for the future. Or if we think that things are going exactly to plan, we just run off the liabilities over time. So that's the running off of the balance sheet components. And eventually, for any one of these issuance groups or profitability groups, the liabilities will eventually run down to zero. So those were the two measurement phases, right? So just to recap, we have initial recognition and we have subsequent measurement. For each of these measurement phases, we can also think about the types of liability that's contained within them. And also there are two types of liabilities that are contained within the measurement phases. So we're going to go through that in this section. But before I take you guys through the, I guess, the terminologies of the liability, I just also want to just do a conceptual recap of what a liability is, because I think a fundamental understanding of what we're trying to measure, it definitely helped me with my calculations for the liabilities. So a liability is something that a person or company owes, right? So if you owe someone either a good or service or a sum of money, you're liable to fulfill that. You're liable to go through with that. When insurers issue an insurance contract, it's a promise. The customers pay the insurer money. We have a promise that if something happens that's part of the agreement, then the insurer is liable to pay that amount into the future. That's the main liability. And we only accept that as insurers for some premiums, and that is the main offset to the liabilities. And typically we charge more premiums than claims, and so therefore we expect to make a profit. Within this liability, there are two subcategories. So one is called your liability for remaining coverage, and the other subcategory is called your liability for incurred claims. And you guys may have already heard of these two liabilities, and I just want to make it very clear about what each of these relate to. Now, how I tend to tie it together is if you think of an insurance product, you're selling a promise, and that promise has a time span, like a contractual term that it goes for, or a coverage period that it goes for. As time progresses into the future, you would have had some cover that have already been provided to customers, and then you also have coverage that you have not yet provided to customers. And so this is why I highlighted these two words, remaining coverage and incurred claims, because the terminology, I believe when the IASB came up with these terms, they were intuitive and the words were chosen carefully to mean exactly what they're trying to measure. So in the next two slides, I'll be going through just briefly what remaining coverage is and what incurred claims means. So let's say we have an insurance cover that's potentially 5 years long, and let's just say we are 1.5 years into the insurance cover. That means there's still about 3.5 years left to run for the insurance cover. Now, claims can happen in that time because we've already signed an agreement where we promise to provide the customer's claims payouts relating to the total length of the cover. If there's no claims in the future, which we don't know, of course, but if there's no claims, then all good. But if claims pop out in the future, then we are liable to fulfill our promises. And because this relates to the coverage that is still remaining, or the remaining coverage portion of our policy, and because if a claim pops out, we are liable to fulfill that, this is called the liability for remaining coverage. And you guys probably can see the other end of it, which is the liability for incurred claims. So for the liability for incurred claims, it's associated with the coverage period that has already elapsed. So for example, you might have a flooding event. It causes damage to a number of properties. That event has already occurred. We've seen it. The insurer will be liable to pay out the claims. The reason why I sell a liability is because we still have yet to fulfill the promises to pay out all of the claims. So that is called the liability for incurred claims. The claims have already incurred, but we have yet to fulfill our promises and paying out all of those incurred claims. So that's why this is called the liability for incurred claims. If we put these two together, we get kind of like a full view. So as I was saying, if I have a 5-year policy, right now we're in July. So let's just say 1.5 years into our coverage period, the liability for incurred claims relates to the cover that has already been provided. The claim could have occurred, but we may or may not know. The future cover would be the remaining coverage. So we haven't even gone into that section of the future yet. Claims could happen in the future. If they happen, then we are liable to pay for those. If you think about that and how that relates to the measurement phases, hopefully you guys can see that at initial recognition, there is no liability for incurred claims. And at subsequent measurement, that's when you have the liability for incurred claims. Because at initial recognition, there's nothing that has, and there's no cover that has elapsed at initial recognition. And if I quickly go through just the paragraph wording again, if I just go back up, you can see that the liability for remaining coverage and the liability for incurred claims, those specific words only come out in paragraph 40 for the underneath the subsequent measurement. Whereas in initial recognition, they don't say the liability for remaining coverage is this, because all of this is remaining coverage. You haven't yet elapsed any part of the cover at that stage at initial recognition. So that kind of like ties into the measurement phases as well. So let's keep going. So we've gone through the measurement phases. We've gone through the liability types. The next bit that we're going to go through would be the measurement methods. The liability for remaining coverage and the liability for incurred claims, those are the types of liabilities, but you need to measure those liabilities. And when you measure those liabilities, IFRS 17 prescribes certain methods or certain simplifications of those methods that you may be able to use to measure or quantify those liabilities. And so this segment will be a short 3 slides going through what these are and hopefully providing some intuitive understanding of why they are so. And because I'm coming from the perspective of a general insurance company, the two measurement methodologies for quantifying those liabilities, they are the general measurement model and the premium allocation approach. There is a third measurement methodology called the variable fee approach, but they apply to directly participating contracts, which are generally not within the general insurance realm. And so for this webinar, we are just going to be focusing on these two, the general measurement model, which I call the GMM, and also the premium allocation approach, which I call the PAA. So they can be used to quantify the LFRC, the remaining coverage portion, or the LFIC. And if we just summarize it briefly, the GMM is the default position. The premium allocation approach is an alternative way that you could use if certain conditions are met. And I won't go through those conditions in general, but you generally need to show that either your coverage periods are short enough or the premium allocation approach is a good enough approximation of the general measurement model. So basically, if you can show that, you're able to use the premium allocation approach. If you can't, then you have to resort to the default general measurement model. And for the main part of the standard, it's all written from the perspective of the general measurement methodology. And it's only when they specifically say this is the premium allocation approach, that's when you can deviate. So the mechanics of the general measurement model and the premium allocation approach, they differ mainly when you're quantifying the liability for remaining coverage portion of your liabilities. And as I was saying just before, the PAA mechanics are much simpler than the general measurement model. And when you're looking at the incurred claims portion, the mechanics of the general measurement model and the PAA, they're very similar when you're quantifying the LFIC. So just to recap, they differ mainly for the LFRC, with the PAA a lot simpler, but they're pretty much the same when you're determining the liability for incurred claims. And for the next two slides, I'm going to have some graphics that shows you guys, I guess, some of the components in the GMM and in the PAA. So there will be some overlap with the next section, but I'm going to save the explanations of those components in the next section. So you can see this is the slide that depicts the general measurement model. So right now we have the liability for incurred claims on the left within the general measurement model, and the liability for remaining coverage on the right. Now, if you kind of like just look at these graphics, you generally find that there is a risk adjustment, there is estimates of future cash flows. Those two components are present for both the liability for remaining coverage and the liability for incurred claims. You have undiscounted and discounting required for both, and I will go through the time value of money in brief shortly afterwards. And the only main difference for the general measurement model methodology is this component called your contractual service margin, or CSM for short. So the CSM basically is supposed to reflect the unearned profit. And the CSM is only in the liability for remaining coverage because your liability for remaining coverage in the general measurement model, the runoff of the liability for remaining coverage depicts how you earn your revenues. So as your liability for remaining coverage runs down, that's when you start earning your top line. That's how you start earning your revenue. And when it runs down to zero, it means you've earned all of your revenue. Whereas the liability for incurred claims, that doesn't go into your revenue. That more or less goes into your expenses. When you start incurring the claims, your liabilities go up, and then you book a claims expense. As you pay your claims, your cash will go down due to the payments that you make, and that's completely met by the reduction in your liability. That's if your actuals is equal to your expected. And so for your liability for incurred claims, that affects your expense line, whereas the rundown for your liability for remaining coverage, that impacts your revenue line. And CSM is the expected profit that you believe you will make across the coverage period for your insurance policy. So the next bit will be the premium allocation approach. So I just want to flick between the two slides briefly, just so visually you guys can see the key differences. So for the general measurement model, you can see on the left, pretty much the same as the premium allocation approach. The only difference is you can see that I've grayed out the undiscounted versus discounted for the liability for incurred claims. This is because the premium allocation approach, it provides some simplifications for not requiring discounting if certain conditions are met, which I won't go through, but you if you meet certain conditions, you don't actually have to do the discounting for the liability for incurred claims. The majority of the discrepancies, as I was saying before, relates to the remaining coverage portion. And so you can see there's quite a big difference between the general measurement model and the premium allocation approach. And this is where I want to give you guys a kind of like a more intuitive understanding, or at least how I understand these two. If you think about what we're trying to measure, we're trying to measure what the insurer still has left to fulfill for the insurance policy and quantify that. And so that means that there are still some amounts that you haven't paid yet. If we look at the general measurement model methodology, how we try to quantify that is we're looking towards the future. So we're liable for claims or for cash flows that we haven't yet paid. So that's contained here. So you estimate, well, how much are we still expecting to pay in the future? You have to slap on a risk adjustment onto that. And I know I haven't gone through the risk adjustment yet, but you have to slap on some risk adjustment on top of that, and you discount that to the present. And that's supposed to reflect how much you still expect to fulfill in the future. CSM is also profit that you only recognize once you've fulfilled your promises. So therefore, this is still a liability until you've fulfilled your promises. So for the general measurement methodology, these three really relates to looking towards the future, that future perspective of deriving the liability at that point in time. When we look to the premium allocation approach, it's a different view. So the premium allocation approach, I like to think of this as looking retrospective. And so when customers pay insurance companies some premium, the insurance companies will receive the premium, but at that instant, you still haven't done anything. So every dollar of premium at that instant, they resemble a promise that the insurance company has kind of like received compensation for, but haven't yet fulfilled anything. So as soon as you receive premiums, your liability goes up because you're saying, all right, we received some money. Now let's book this liability because this resembles the promise that we still need to pay the customers. Then when you actually pay acquisition expenses, you've done some bit of work to acquire the business. You're kind of like working your way through to try and provide those services so you can reduce the liability by that amount. And when you actually earn the premium, this is the major part of your, I guess, the premium PAA, liability for remaining coverage. As you earn your premium, what you're saying is, we've just provided this service for this period. We are going to earn the portion of the premium that relates to the obligations that we have just provided. So therefore, you're going to reduce your PAA liability for remaining coverage by that amount. And when you earn your acquisition costs, that's kind of like writing down your acquisition kind of like expense asset in today's terms. So that kind of like goes in the opposite way. You put all of these together and we get the PAA liability for remaining coverage. And so you can also, another perspective of thinking about this is that both of these liability for remaining coverage, they're trying to measure claims or payments that you're trying to be making relating to claims that haven't yet occurred. If we think about today's requirements, that's kind of like our general insurance premiums liabilities. But in today's terms, there's two ways you can determine those premium liabilities, or two standards that requires you to determine those premium liabilities. One is the actuarial standards. And the actuarial standards of premium liabilities requires you to do it more or less in the general measurement model methodology way. Obviously not including the CSM, but we're looking at risk adjustments and estimates of future cash flows. Not exactly the same, but in principle, it's trying to look at that forward approach. The other methodology for the premium liabilities in today's standards would be our accounting methodology, or the AASB 1023 methodology. And in that methodology, we're looking retrospective. We're again looking at our unearned premium reserve, which is more like the premiums received minus the premiums earned, right? That's how much premium we have yet to earn, and we'll earn in the future as we fulfill our promises. So the PAA, liability for remaining coverage, I like to think of this as analogous to the current AASB 1023 premiums liability, whereas the general measurement model liability for remaining coverage, I like to think as more analogous to the current APRA premiums liability, or the actuarial premiums liabilities in today's terms. For the liability for incurred claims, these relate to claims that have already occurred. And if you think about in today's terms, these are like our outstanding claims liabilities. And we basically determine them in more or less a similar way, regardless of a measurement methodology. So that's probably why, or at least my interpretation of why, of the similarities between the PAA and the general measurement model methodologies for measuring the two types of liabilities compared to today's requirements from APRA and also from the AASB. So that's the kind of like the recap for the liabilities, the two types of liabilities and the measurement methodologies relating to those liabilities. And as I was saying, that we can easily take up an entire webinar if we wanted to talk about measuring these, how can we quantify these, what happens when assumptions change, how would that affect the CSM? That can be taken up by an entire another webinar for the mechanics of these and comparisons between the two. What I'm going to be talking about for the final section before I start closing it off would be the specific components. So the interpretation, or my interpretation, of risk adjustment, how you can think about the future cash flows, the contractual service margin, etc. So this is the liability component section. It's a little bit longer of a section compared to the previous 3 sections that we've gone through. So just as a recap, we went through the measurement phases, we went through the liability types, we went through the liability methodologies. Now we're looking at the liability components. So there are 4 components that I'm going to be talking about. One is the cash flows, or the future cash flows. The other one will be the risk adjustment. The third one will be the time value of money. And then the fourth one will be the contractual service margin. The future cash flows requirement basically is, there's a lot of paragraphs in the IFRS 17 standard that talks about future cash flows, but I like to kind of like condense that into something kind of like that just makes intuitive sense. So really it is cash flows, any cash flows that's associated with providing insurance services, right? That's a cash flow because you're selling customer this insurance product. You're going to provide them services. Well, what are all of your outflows that are relating, or your inflows relating to the provision of those specific services? What would you have to do? Those are cash flows that you have to consider. That's kind of like in short. And also, it's only a liability because you haven't yet paid them, right? If you paid them, then great. But if you haven't paid them, that's when it forms a liability. If you guys have access to the accounting IFRS 17 standard, you can look at IFRS 17B, this is in Appendix B, B65, and IFRS 17 B66 to provide examples of cash flows that are to be included or examples of cash flows that are to be excluded. And just as a recap of, I guess, how the IFRS 17 standard is laid out, you have the main part of the standard, which is already quite long, a lot longer than the current standard. Then you have Appendix A of the standard, which is definitions. You have Appendix B of the standard, which provides greater clarity for certain points raised in the main part of the standard. So Appendix B of the standard is actually also quite long. And then you have Appendix C of the standard, which more or less deals with the transition requirements. So Appendix B is often referenced the most of the standard, and paragraph B65 and paragraph B66 of the standard, they give examples of cash flows that, or examples of cash flows that IFRS 17 or the board believes that should be included or excluded. So if you need some, I guess, examples of those, please go to that section of the insurance standard. So that's cash flow. So assuming that you've already included the relevant cash flows in there, we're going to run to the next section now, which is the discount rates. So let's just say you've isolated all the cash flows. You know what cash flows relate to the insurance contracts. You've included all of those. Then you need to discount them. You need to adjust for the time value of money. And I do appreciate that most of you guys, you kind of like do all of the discounting automatically, or you have models set up to do that. I just want to run through the intuitive understanding of some of these, because there is also a component of, I guess, the liquidity premium that they've also added into the standard as well. So I feel like having a bit more of an intuitive understanding could resonate a little bit more of why we're doing what we're doing. So the insurer, we expect to pay claims and expenses in the future. Those are cash flows that we've identified in the first component of our liability just before. But there's an opportunity for the insurer to invest them. So if you're going to pay $10,000 in the future, but now we're today, well, you actually don't need to hold $10,000 in today's money terms. So there's an opportunity for you to maybe put it $9,000 or just hold $9,000, invest it in some assets, risk-free assets, and for that to grow to $10,000. And therefore, when you're actually booking your liabilities in today's terms, you generally, assuming positive interest rates, you generally can book less than the ultimate amount they're going to pay out in the future. That's what we call the adjustment to reflect the time value of money. That adjustment is made with reference to discount rates. And as I was saying before, that opportunity will only be relevant if if you have a risk-free ability. The other thing that the IFRS 17 has introduced is a liquidity adjustment, or a liquidity characteristic adjustment. And the reason is because, and you can read this in the basis of conclusions, which is a supplementary document to IFRS 17. The reason they make adjustments to those is when you set aside that money for the opportunity for that money to grow to fulfill your future obligations, you have to invest that in some assets. And when you invest in assets, in order for you to convert those assets to pay those future amounts, there's a liquidity requirement that needs to be satisfied. You may not be able to sell immediately, etc. And so there's kind of like a disjoint between the liquidity characteristics between the insurance policy and also the assets backing the insurance policy. And this is a reference in one of the paragraphs in the basis of conclusions. The board of IFRS 17 wanted to come up with a way to align these a little bit more. And so therefore they wanted the liquidity characteristics to also be reflected in the discount rates used to do the discounting for the insurance contracts that you're evaluating. And so that's a kind of like my interpretation of the liquidity characteristics. And so you put those two together, and those are the two main adjustments for the discount rates. The standard does give you the option to determine this using two different principal methods. One is top-down approach. The other is the bottom-up approach, but we won't go into the mechanics or the intricacies of those two methodologies for the discount rates determination. But just to know that you got to allow for the time value of money, and that's allowed through the discount rates. And the discount rates needs to reflect credit risk and also liquidity characteristics. So now we move on to the risk adjustment. And if we kind of like just look at the requirement for the risk adjustment, IFRS 17 says that an entity shall adjust the present value of cash flows to reflect the compensation that the entity requires for bearing the uncertainty about the amount and timing of the cash flows that arises from non-financial risk. I've thought about this for a while, and the way I approach this is to think about, from a principal perspective, what is the objective of IFRS 17? And from a principal perspective, the objective of IFRS 17 is about comparability. And so when we're considering our cash flows, our cash flows are uncertain because it's all estimates, right? Everything's up in the air. It's not like you're selling a product that's certain, you're selling an iPhone that's certain, that's set in stone. When you're conveying a promise that you will pay claims, the estimates could go up and down at any time. So there is a probabilistic factor associated with that. So first question is, well, how much is the insurer willing to pay someone else to be certain about the amount and timing of those cash flows? So you have these cash flows that could go up or down. If the insurer somehow could pay someone for the fluctuations to disappear, how much can they pay? How much are they willing to pay to convey that certainty? So you might adjust for things like insurance risk, lapse risks, expense risks, and other non-financial risks. If you're able to do that, assuming that theoretically the insurer is able to calculate some theoretical sum to convert a fluctuating cash flow estimate in the future to make that completely certain, then you're at a place where you're more comparable between that and, say, a non-insurance company, because they don't have that kind of like always changing assumption view of the future when they sell their products. There's a lot less volatility there compared to insurance companies. And so if you're able to do that, it provides more comparability between insurance and non-insurance company balance sheets. And the IASB did recognize that different insurers have different risk aversions. And so therefore, they want you to disclose the confidence level that the risk adjustment corresponds to convey some of that risk aversion. And people generally, I've seen they compare risk margins and risk adjustments hand in hand. And I just wanted to just say a few words of how I see these two playing out. So risk margins are already required in the current general insurance practices, but the aim of them is to ensure that the value of the insurance liabilities is established at an appropriate and sufficient level. So it's to do with solvency, it's to do with that the insurance company shouldn't go under, whereas risk adjustments are aimed at to ensure greater comparability between the balance sheets. These are both amounts that you add onto your claims estimates, but the objectives of these are different. They may be the same, they may be different, but you can see that the principles behind those are different. So risk margins represent a buffer to protect insurance solvency, whereas risk adjustments represent adjustment to ensure greater comparability. So solvency versus comparability. So I'm just going to put those concepts together again, and then I'm going to close it off with CSM and then what's next. So general measurement model, premium allocation approach, the two measurement methodologies. The fulfillment cash flows, or the cash flows relating to promises that the insurance company still has yet to fulfill, they are both contained within the LFRC, remaining coverage, and the LFIC, the incurred claims liabilities. The adjustments are made for fulfillment cash flows for the time value of money, and there's a risk adjustment added to those as well. And by the way, a lot of these components that I've just talked about, they apply mainly for the general measurement model, liability for incurred claims, liability for remaining coverage, and also for the premium allocation approach, but only for liability for incurred claims. The liability for remaining coverage, as you saw before, was quite different. So it's really these three columns that those components mainly relate to. CSM is an additional element on top of the fulfillment cash flows in the liability for remaining coverage for the general measurement model. And the PAA liability for remaining coverage, they use a less complex method, which I haven't gone through in detail today. So the last thing is the contractual service margin that I want to talk about, which is this yellow bit in the general measurement model liability for remaining coverage. As I was saying before, this contractual service margin, it resembles the expected profit that you haven't yet earned. And within the paragraph wordings from IFRS 17, you can see that it says exactly that. It represents the unearned profit that the entity will recognize as it provides these services in the future. When you provide these services, you will de-recognize the liability relating to the CSM, and you will recognize revenue relating to the CSM. But in what pattern? So the CSM relates to services and you need some way to measure those services. IFRS 17 comes up with the term called coverage units. And coverage units represents units resembling the quantity of benefits that the customer expects to receive for across the coverage of the insurance contract. And so if you're able to come up with a way to measure that, then you have a way to earn your CSM into profits. There's no specific guidance on exactly how to determine these coverage units. However, the overall consensus through the different, I guess, the groups, the transition resource groups and the board meetings over time is that the coverage units shouldn't make specific reference to anything associated with probabilities, right? So they make reference to standing ready to provide customer services. And so there is kind of like two things acting here, because you're talking about the future. And so when you're talking about the future, there is a lot of uncertainty. There is a lot of probability involved. But when you're providing services, then is there a way to remove that and just look at, well, what is our promise? Have we changed our promise to the customer? And if we can somehow measure that promise, then perhaps we have a way to earn just our profit that we're providing to customers. And so this is very specific to insurance companies. If you're selling an iPhone, your profit is a lot more certain. You don't have to come up with coverage units to measure the quantity of benefits, because the iPhone is the benefit. It's a lot more certain. And a lot of insurance companies, I find, have a lot of trouble coming up with this coverage unit over time. So the final thing that I want to finish off on is what's next. And so there are a few points that I just want to draw out. You guys may or may not be in the know that APRA is finalizing the capital reporting standards in the third quarter of this year. So it's very soon. They have already publicly released some letters talking about their approaches and also some draft reporting and capital standards. So they're going to be finalizing that in Q3 this year. In terms of GI actuarial reserving methodologies, from what I can tell, there's no direct impact from IFRS 17 in the reserving methodologies themselves. So things like coming up with your payments per claims method, your incurred chain ladder method, or any of the actuarial reserving methodologies, I can't see any direct impact to them. The only impact I can see is after you've come up with your results, you may need to dissect your results or come up with the changes in your results in a more granular basis compared to before. So that's where the next 2 points is relevant. Data and automation, I believe, are key to long-term success. Oftentimes, it is hard to ensure that your data and your processes are automated because there's a big legacy of these processes. And there could be a significant cost to improving those processes. But I strongly believe that if you're able to automate things and set things right the first time, there will be significant savings. And I have seen significant savings in some companies over the long term. But it has to be done right. And it also has to be maintained over time. If you're able to have greater granularity in your calculation, so for example, when you calculate your reserves, having the splits between when you change interest rate, changes due to interest rates, changes due to assumptions, and have all of those granular items itemized, then that will help produce the reports relevant for APRA, relevant for the AASB. And because now we're measuring things according to different terms, insurance services, liability for remaining coverage, liability for incurred claims, and I can already see different companies, they're planning their budgets and plans more in line with IFRS 17 terminologies. The performance metrics may change, but we've got to wait to see where the industry moves together on that front. So that's all I have for today, and I will just open it up for questions.
Thanks, Owen. hopefully I'm sharing my video as well. I just thought I'd jump in here and help you out with disseminating some of these questions. Looks like we've got one here on the impact, particularly for PAA. So it says you talked about the PAA being more aligned with the current accounting numbers, and GMM, the general model, more akin to current actuarial APRA practices. So putting this into practice, does it mean that entities adopting PAA, like private health insurers, GIs, and other than a lender's mortgage, will not have their financial statement numbers change significantly? So I guess it's more, talking to the change from 1023 to IFRS 17 under PAA.
Yeah, good question. And I just want to, I guess, lay out two aspects here. So what I was referring to is the measurement methodology, kind of like analogous to the current premium liabilities from the AASB. There is still a big change for disclosure requirements. There's still a big change for, I guess, how you, in what levels of granularity you have to do your measurements, and APRA will have requirements in terms of how you report to APRA as well. So I don't believe that the change will be minimal in terms of the auditing. I believe that all of the auditors will be a lot more strict, at least in the first year when they're looking at the financial statement numbers. There's a lot more reconciliations and the matrix contained within the reconciliations that's needed. So definitely, I don't think that the change will be small. But what I do mean is that when you're thinking about this from a conceptual standpoint, it's more analogous to kind of some of the current ways that we do things. But in terms of being audited, I think that's a different topic altogether.
So risk margins are seen as a prudential tool, whereas risk adjustments are an accounting tool designed for the purpose of achieving, I think we've got a clarification here, achieving comparability with other industries. Is that a fair statement, or have a view on that?
That's just my interpretation. So when I spent quite a lot of time going through the standard, the IFRS 17 standard, going through all of the basis of conclusions, going through, I guess, all of the different board meetings as well, and also looking at what the UK and other countries are doing, and try to make sense of what is the aim here. And so this is kind of like where I've landed. And obviously, this is not prescriptive of what the industry thinks, but this is how I see risk adjustment settings, because the whole purpose of IFRS 17 is to ensure greater comparability and also a more faithful representation of what's actually happening. Whereas APRA requirements for risk margins, they have a different objective.
And please, as we go through the last couple of points, if there are any other questions, pop them in the chat. We have had a couple of requests for the slides. I think I mentioned at the start, the session will be, it is being recorded, so we'll pop that up on the website, and I think you can play this back at your own convenience. But we'll have a chat with Owen offline and see whether there's any possibility around slides as well, potentially on request. But I'll leave that to you, Owen, to answer that one and how comfortable you are on the slides. And will there be any discussion or potentially a session in future on VFA and life insurance?
Right now, there is no plans on providing a life insurance specific session. It's more to do with Real Value Consulting's expertise is more conducive to general insurance companies, and we only propose to provide real value. So we only propose to give advice and present on areas where we believe that we are right to give advice on. And so, yeah, right now there's no plans to do that. However, if we do venture off and specialize a bit more in the life insurance space, then yeah, that could be on the cards.
Okay, we've got another question come through, or a couple there. Liability for remaining coverage is only recognised when premium is received per IFRS 17. but there is premium receivable when premium is written before receiving any funds. Is premium receivable still recognised per AASB 9 and then reversed when LFRC is recognised? What happens to the proportion of premium debtors that is not received?
So I think that's kind of a more technical question, and we may need a bit more clarity around that. But in terms of the premium receivable, and by the way, I believe your question is more attuned to the PAA approach. In the liability for remaining coverage, the standard does say that your premiums that you earn, you can earn your premiums based on the premiums you expect to receive, but the liability only, so that's the earning for your premiums that reduces your liability for remaining coverage in the PAA. But when you actually do receive the premiums, that increases your liability for remaining coverage. So that's probably all I want to say there before I say something that could potentially be misinterpreted or is incorrect.
Okay. I think we've got through most of the questions. There's one I might leave you with to wrap up, but I just want to say before that, thank you, Owen. Once again, you've got a real, and I actually think someone mentioned it here, you explain it in really plain English. And I think the slides and your presentation was excellent. So thank you so much. But we do have one other question here, and that's I think from Ryan asking, just a bit more about what services Real Value Consulting can provide on IFRS 17 as we bring this to an end. But
Thanks,
I'll
Ryan.
hand over to you.
And definitely that was not a planted question. So, but thank you, Ryan, for giving me this opportunity and segue to run into the last slide. So, yeah, if you like, I find a lot of the work, in order to do the work properly, you need people and resources that can understand what's actually being done. And if you understand what you're actually doing, then you can actually save a lot of time because you don't have to redo things that have been done the wrong way before. So a big component of the expertise of Real Value Consulting is to provide proper training to explain concepts, to explain content, or to understand what you're currently doing, and to maybe provide insights on whether you're doing things the right way or believe that you're doing things maybe not in the most appropriate manner. And so that's the education and the training is a big component of Real Value Consulting. Obviously, there are other components in there that we also provide. So if you do require someone to come in and maybe just to have a look at how you're kind of like approaching the IFRS 17 measurements, and to look at whether to review the work that you've done, then definitely we have that as part of our services as well. And we imagine the services will kind of like evolve over time depending on the industry demands, but the training element is a core component of our, I guess, our value proposition.
Okay, thanks again, Owen. And I guess there was one final request here around if you missed the first session, which is held earlier in the year, can you get access to slides? I think please feel free to write to the FSAA mailbox, and we can see if we can get you access to that session that was recorded as well. Or if not, we'll arrange something in conjunction with Owen to get that to you. All right. Well, hope you all enjoy the rest of your day, and thank you so much for joining, and thank you once again, Owen.
Cheers. Thanks,
See you next
guys.
time. Thank you.
Catch you later.